Welcome back to the channel. Today we're diving into a critical topic for all stock traders out there. The impatient trader's dilemma. Why emotional decision-making leads to financial losses. Look, I get it. You see the charts, you hear the success stories, and you want to make a killing in the market like yesterday. But here's the thing. Impatience is a one-way ticket to blowing up your account. Think about it. How many times have you made an impulsive trade based on FOMO, only to see it go south immediately, or panicked and sold at the worst possible time because you couldn't stomach the thought of losing a few bucks? We've all been there, trust me. I've made more trading mistakes than I care to admit, but over the years, I've learned that the key to long-term success in the stock market isn't about chasing quick gains or timing the market perfectly. It's about mastering your emotions and developing a disciplined approach. In this video, I'm breaking down the most common emotional pitfalls that plague impatient traders and sharing actionable strategies to help you stay cool, calm, and collected when the market heats up. Let's talk about how our emotions can sabotage our trading decisions. When we let fear, greed, and anxiety take the wheel, we're basically setting ourselves up for disaster. Fear can paralyze us, making us miss out on potentially profitable opportunities. Greed, on the other hand, can make us reckless, chasing after every hot stock tip without considering the risks. And then there's anxiety, that constant nagging feeling that we're missing out or making the wrong move. It's like a recipe for disaster. You see a stock dipping a little, your heart starts racing, and you hit the sell button in a panic, only to watch it skyrocket the next day. Been there, done that. Or you get caught up in the hype, throw all your money into a meme stock without doing your due diligence, and then watch your portfolio go up in flames. The point is, our emotions can cloud our judgment and lead us to make irrational decisions that we later regret. That's why it's crucial to develop emotional awareness and learn how to manage our emotions effectively when trading. One of the biggest mistakes I see traders make is jumping into the market without a clear plan or understanding of why they're even there. Let me tell you, trading without clear goals is like setting sail without a destination. You're just drifting aimlessly, hoping to stumble upon treasure. Without clearly defined objectives, it's impossible to measure your progress, track your performance, or even know if you're heading in the right direction. This lack of direction can lead to frustration, impatience, and ultimately, poor decision-making. You might find yourself chasing after every shiny object that catches your eye, jumping in and out of trades without any real conviction. This kind of impulsive behavior is a surefire way to rack up losses and sabotage your long-term success. Look, I'm going to be blunt here. If you're not managing your risk, you're essentially gambling with your money. It's like playing Russian roulette with your portfolio. Risk management should be the cornerstone of every trading strategy. Without it, you're leaving yourself completely exposed to the market's whims. Inadequate risk management can manifest in many ways, from not setting stop-loss orders to risking way more than you can afford to lose on a single trade. When you don't have a plan to limit your losses, even a small market dip can wipe out a significant portion of your capital. This can lead to a vicious cycle of chasing losses, where you become increasingly impatient and make even riskier trades in an attempt to recover your losses. It's a slippery slope that can quickly spiral out of control. Chapter 4: Information Overload. We live in a world of constant information overload. And let's face it, the financial news cycle is relentless. Every minute there's a new headline, a new tweet, a new expert prediction, all screaming for your attention. It's enough to make anyone's head spin. This constant barrage of information can be overwhelming, leading to analysis paralysis, fear-based decision-making, and ultimately, impulsive trades. When you're bombarded with conflicting opinions, market rumors, and breaking news alerts, it's easy to get caught up in the noise and lose sight of your trading plan. You might find yourself second-guessing your strategy, chasing after the latest hot stock tip, or making rash decisions based on fear or FOMO. Remember, not all information is created equal. In fact, much of the financial news out there is just noise designed to grab your attention and generate clicks. Chapter 5. Frequent buying and selling. Look, I know it's tempting to try to time the market perfectly to buy low and sell high every single time, but here's the cold, hard truth. It's impossible. And constantly chasing those short-term swings is a recipe for disaster. Every time you buy or sell a stock, you incur transaction costs, and these costs can add up quickly, eating into your profits and making it even harder to come out ahead. Not only that, but excessive trading can increase the likelihood of slippage, which is the difference between the price you expect to get and the price you actually get when you execute a trade. This can happen in fast-moving markets, where prices can change rapidly. The more you trade, the more you're exposed to these costs, and the greater the chance of making impulsive decisions that you'll regret later. Chapter 6. Poor Risk-Reward Ratio. Let's talk about the risk-reward ratio, one of the most important concepts in trading. Simply put, the risk-reward ratio is the potential profit you stand to gain from a trade relative to the potential loss you're willing to risk. Impatient traders often fall into the trap of chasing quick gains without considering the potential downside. They might jump into a trade based on a hot tip or a gut feeling, without taking the time to assess the risk involved. This can lead to situations where they're risking a significant portion of their capital for the chance to make a relatively small profit. For example, an impatient trader might risk $1,000 on a trade with the potential to make $100. That's a risk-reward ratio of 1 to 10, meaning they're risking $10 for every $1 of potential profit. This is a recipe for disaster. Imagine this. You've done your research, identified a solid investment opportunity with long-term growth potential, and you're ready to hit the buy button. But then, doubt creeps in. You start second-guessing yourself, wondering if you should wait for a better entry point or chase after a different stock that seems to be moving faster. This is the impatience trap in action. By constantly chasing after the next big thing, impatient traders often miss out on the real opportunities that lie right in front of them. They become so fixated on short-term gains that they fail to see the bigger picture. Remember, building wealth in the stock market is a marathon, not a sprint. It takes time, patience, and discipline to ride out the market's ups and downs and come out ahead in the long run. Before you even think about placing a trade, ask yourself, what are you trying to achieve? Are you looking to generate passive income, save for retirement, buy your dream house? Once you have a clear understanding of your financial goals, you can start developing a trading plan that aligns with those objectives. Your trading plan should outline your investment strategy, risk tolerance, and the specific steps you'll take to achieve your goals. Think of it as your roadmap to success in the stock market. Remember, clarity breeds confidence, and when you're confident in your plan, you're less likely to make impulsive decisions based on fear or greed. Risk management is non-negotiable. It's like wearing a seatbelt when you're driving a car. You wouldn't even think about hitting the road without it, right? First and foremost, never invest more than you can afford to lose. This might seem obvious, but you'd be surprised how many people let their emotions get the best of them and end up risking money they need for rent, groceries, or other essential expenses. Secondly, use stop-loss orders. A stop-loss order is an order that automatically sells your stock at a predetermined price, limiting your potential losses. It's like having an insurance policy for your trades. Finally, diversify your portfolio. Don't put all your eggs in one basket. Instead, spread your risk across different asset classes, sectors, and geographies. Chapter 10. Practice emotional control. Trading can be an emotional roller coaster, and it's easy to get caught up in the heat of the moment. That's why it's crucial to develop strategies for staying calm, focused, and in control of your emotions. One of the most effective ways to manage trading-related stress is to practice mindfulness. Mindfulness is the practice of paying attention to the present moment without judgment. It involves focusing on your breath, body, and thoughts without getting carried away by them. Meditation is another powerful tool for cultivating emotional regulation. Regular meditation practice can help you develop greater self-awareness, reduce stress and anxiety, and improve your focus and concentration. Chapter 11. Focus on long-term trends. Instead of chasing after quick gains, shift your focus to identifying long-term trends and opportunities. This means looking beyond the daily noise of the market and focusing on the bigger picture. Technical analysis involves studying charts and historical price data to identify patterns and trends that can help you predict future price movements. Fundamental analysis, on the other hand, focuses on evaluating a company's financial health, management team, competitive landscape, and overall industry outlook to determine its intrinsic value. By combining these two approaches, you can gain a more comprehensive understanding of the market and make more informed trading decisions. Chapter 12. Stay informed, not obsessed. It's important to stay informed about market events and news that could impact your investments. However, there's a fine line between staying informed and becoming obsessed with the market. Constantly checking your portfolio, reading every news article, and watching every financial news segment will only serve to increase your anxiety and make it harder to stick to your trading plan. Instead of being glued to your screen 24/7, set aside specific times each day to check the markets and catch up on relevant news. This will help you stay informed without becoming overwhelmed by the constant flow of information. In today's digital age, we have access to a wealth of tools and technologies that can help us make more informed and rational trading decisions. From trading platforms with advanced charting tools to portfolio management software that tracks our performance, technology can be a powerful ally for the patient trader. One of the most significant advantages of using technology in trading is the ability to automate certain tasks, such as setting stop-loss orders and taking profits at predetermined levels. This can help to remove emotion from the equation and ensure that you stick to your trading plan even when the market gets volatile. Another benefit of using technology is the ability to backtest trading strategies. Backtesting involves testing a trading strategy on historical data to see how it would have performed in the past. Trading can be a lonely endeavor, especially if you're doing it solo. Surrounding yourself with a supportive community of like-minded individuals can provide valuable insights, encouragement, and accountability. Consider joining online trading communities, attending industry events, or connecting with other traders on social media. If you're serious about taking your trading to the next level, you might also want to consider seeking guidance from a financial advisor or trading coach. A qualified professional can provide personalized advice, help you develop a tailored trading plan, and offer support and guidance along your journey. Remember, trading is a marathon, not a sprint. It's about making calculated decisions, managing your risk, and staying patient through the market's ups and downs. By understanding the pitfalls of impatience and implementing the strategies outlined in this video, you can develop the discipline and emotional resilience needed to achieve your long-term financial goals. So next time you're feeling the urge to make an impulsive trade, take a step back, breathe, and remember the lessons we've covered today. Thank you for watching. If you found this video helpful, please do me a favor. Like and share this vital information with everyone you care about, so that I can continue to provide these types of crucial information. Remember, knowledge is power, and the more informed you are, the better equipped you'll be to navigate the complexities of the stock market and achieve your financial goals. Don't forget to subscribe for more insights and tips on achieving success in the stock market. Until next time, stay focused, patient, and informed.